Welcome back, everyone, to the channel, The Millennial Messiah. And we got a new microphone, so hopefully now the audio will be much better and everyone will be able to hear clearer as we got a new headset. So we're looking forward to continue reading The Lords of Easy Money. We're on chapter 3, The Great Inflations, and let us begin. Chapter 3, The Great Inflations, 1980 through 1991. Honig was 33 years old when the banking crisis started, but the forces that combusted in the 1980s had been building for many years. Honig's team of examiners in Kansas could be seen for themselves that the banks hadn't been making riskier and riskier loans for years. But the bankers could always justify what they were doing. They were using a certain logic that was made possible only by the wild distortions of the great inflation of the 1970s. Consumer prices were rising sharply every year, and asset prices were rising in sync with them. Bankers are making these loans an environment where asset values are strong and rising, Honig explained. This puts the Fed examiners in a bind. They believed that bank loans were risky, but the asset prices underpinning those loans were probably overvalued. But the bankers argued back, pointing out that the asset prices were marked according to fair market value. The value of assets isn't a fixed or even a knowable thing. It's a matter of judgment. Examiners are no more able to predict the future than the bankers are, Honig said. This whole experience and the massive financial ruin that followed in its wake provided Tom Honig with the most important education of his career. It taught him in very fine detail about the powerful and unruly thing that economists called an asset bubble. Decades later, the Great Inflation was not usually described in terms of asset bubbles. When people look back on the 1970s, they tend to talk only about one half of the disaster, the shocking inflation of consumer prices for things like meat and gasoline. But the Great Inflation was so destructive because it was actually two kinds of inflation that were intertwined and which fed off of each other. The other one was the inflation of asset prices, a phenomenon that later became the most important feature of American economic life. Asset inflation was the force behind the dot com crash of 2000, the housing market crash of 2008, and the unprecedented market crash of 2020. It was precipitated by the coronavirus outbreak. An asset is anything a person can buy that stores value. A ham sandwich is not a good asset because it loses value with time, making it a consumer good. A bar of gold, on the other hand, is an asset. A share of stock is an asset. A painting is an asset. An apartment building is an asset. The Federal Reserve can stoke asset inflation when it keeps money too cheap for too long, pushing asset prices so high that they are no longer supported by the actual value of the asset. This is when asset prices become a bubble. One of the best examples of an asset bubble was described in 1955 by the economic historian John Kenneth Galbraith in the Department of Some Things Never Changing. Galbraith was described as an asset bubble in Florida real estate in the early 1900s. Developers were expecting a lot of people to move to the state, so they brought big tracts of land and subsidized and divided it into neighborhood plots. Then they sold deeds of ownership for the plots. In this case, the actual land in Florida was an asset, and the deeds to the land were an asset. Because the paper deeds could be bought and sold, speculation in Florida real estate took off. The price of land and the price of deeds for the land spiraled upward. The asset inflation was stoked by the very fact that asset prices were rising in the first place. One person bought a deed and sold it for more money, and this enticed yet a third person to buy the deed because its price was going up. If this cycle could go on forever, the world would be a much happier place. But inevitably, the price of an asset converges with the actual value of the asset. In Florida, this convergence happens when it became clear that the expected hordes of people were not moving there. Hurricanes kept hitting the state, dissuading new homeowners, and a lot of overhyped subdivisions were located on hot, humid stretches of swamp without a beach in sight. People started selling. Then everyone started selling. The bubble burst, and the asset price collapsed. Tom Honig watched in the 1970s as asset bubbles inflated across the Kansas City Fed's district, which included both heavy farming states like Kansas and Nebraska and the energy producing states of Oklahoma. The self reinforcing logic of asset bubbles was painfully evident in farming. When the FOMC kept interest rates low, it encouraged farmers to take on more cheap debt and buy more land. This in turn stoked demand for farmland, which pushed up land prices. The higher land prices encouraged more people to borrow and buy yet more land. The bankers' logic followed a similar path. The bankers saw farmland as collateral on the loans, and they believed the collateral would only rise in value. More lending led to more buying, which led to higher prices, which led to more lending. The same thing was happening in the oil and natural gas business. Rising oil prices and cheap debt encouraged oil companies to borrow money and drill more wells. The banks built a whole side business dedicated to risky energy loans. In commercial real estate, it was the same thing. This is how asset bubbles escalate in a loop that intensifies with each rotation. With the reality of today's higher asset prices driving the value of tomorrow's asset prices even higher, increasing the momentum even further. While Honig and his team were arguing with the bankers, the FOMC was stoking the great inflation even more by keeping interest rates low. But this stopped in 1979, and it stopped with a severity that has never been repeated. It was stopped because of one person, Paul Volcker, who became chairman of the Federal Reserve. Volcker was serious about beating inflation. He was willing to push the unemployment to 10% to do so, to force homeowners to take out mortgages that carried 17% interest rates or higher, and to make consumer loans so expensive that many Americans couldn't afford to buy cars. Volcker recognized that when he was fighting inflation, he was actually fighting two kinds: asset inflation and price inflation. He called them cousins and acknowledged that they had been created by the Fed. The real danger comes from the Fed encouraging or inadvertently tolerating rising inflation and its close cousin of extreme speculation and risk taking. In effect, standing by while bubbles and excesses threaten financial markets, Volcker wrote in his memoir. Volcker's predecessors had encouraged these risks, but Volcker would not. Under his leadership, the Fed raised short term interest rates from 10% in 1979 to 20% in 1981, the highest they have ever been. When the history of interest rates is plotted on a graph, this period of super high rates looks like a mountain peak. This is why Volcker's tenure as Fed chair is such an important period in the history of U.S. monetary policy. He is remembered as one of the few people willing to initiate the brutal shock therapy necessary to correct years of mistakes. Volcker's rate hikes devastated the economy, put millions of people out of work, and ended the Great Inflation. At first, people didn't think Volcker was serious about raising rates. Then, they didn't think he'd actually be able to do it. Right after he started doing so in October 1979, there were rumors that he had resigned under pressure. It seemed inconceivable that the Federal Reserve would go through with a plan that would push the economy into a recession. Volcker held an emergency press conference in the Eccles building on a Saturday evening to announce that he wasn't leaving and that the Fed was serious about interest rates. "I'm still alive, contrary to the latest rumor," Volcker told reporters. That weekend, short term interest rates were 11.6%. By the end of the month, they would be 16%. In less than a year, they reached the high of 20%. The reporters pressed Volcker that Saturday night, asking if the rate hikes would damage the economy. He was largely dismissive of the question. "I would be optimistic in the result of these actions," he said. "I think the best indications that I have now in an uncertain world is that it can be accomplished reasonably and smoothly." Volcker was wrong on this point. Nothing went reasonably smoothly. The American economic ecosystem had settled itself around the North Star of low interest rates. Volcker moved the pole star overnight and everything reoriented. A decade's worth of resource allocation would change and everything would shift back in the edge of the yield curve away from risk. The change was wrenching. It played out very quickly in the Kansas City Federal Reserve's district. The bankers were caught totally off guard. You could see that no one anticipated that adjustment. Even after Volcker began the address to inflation, they didn't think it would happen to them, Honig said. Then Paul Volcker and the Fed doubled down the cost of borrowing. The demand for loans slowed, which in turn depressed the demand for assets like farmland and oil wells. The price of assets began to converge with the underlying value of the assets. The price of farmland fell by 27% in the early 1980s of oil, from more than $120 to $25 by 1986. The collapse of asset prices created a cascading effect within the banking system. Assets like farmland and oil reserves had been used to underpin the value of bank loans, and those loans were themselves considered assets on the bank's balance sheets. When land and oil prices fell, the entire system fell apart. Banks wrote down the value of their collateral and the reserves that they were holding against default. At the very same moment, the farmers and oil drillers started having a hard time meeting their monthly payments. The value of crops and oil were falling, so they earned less money each month. The bank's balance sheets, which was once looked stable, began to corrode and falter. Honig's examiners had the unpleasant job of pointing out the obvious. The financial health of the banks were collapsing along with asset prices. Predictably, the banks fought back. The bankers almost always asked for more time. They promised that if they were given a chance, a few more months or a few more quarters, they could turn things around. Asset prices would rise. The balance sheet would improve. Honig's team spent most of the early 1980s doing one thing: deciding which banks could actually survive if given more time, and which banks were doomed. John York was a Fed lawyer who worked closely with Honig during this period, and he said that the debates with the banks had a desperate edge. There was a clock ticking behind the arguments that decided which banks were solvent because banks were asking the Fed for emergency loans. The Fed was the lender of last resort, and its power in this role was almost limitless. It could print money, so it could lend as much money as it chose to. But Congress had imposed one limit on this power. The Fed wasn't supposed to lend to banks that were going to fail. The emergency loans were doled out through the Fed's so-called discount window. Tom Honig oversaw the Kansas City Fed's discount window in the 1980s. When his team decided who could borrow from the discount window, they were rendering life or death judgment on banks. A true panic broke out in 1982, the worst since the Great Depression. More than 100 banks failed that year, far more than in any single year since the 1930s. In 1986, the rate was higher, with more than 200 banks failing. Overall, more than 1,600 banks failed between 1980 and 1994. The bankers came to the Kansas City Fed in a parade pleading their cases. All of them pitched plans under which they would stay solvent, and Honig developed a broad rule of thumb to evaluate them. He noticed that the best plans had a lot of detail. The worst plans were vague and peppered heavily with platitudes. Bankers, Honig came to believe, were like anyone else. Some of them were honest and hardworking. A small minority were hucksters, but it wasn't just the hucksters who were failing. Many of the failed banks had been in business for generations. They were the financial pillars of small communities throughout the region. John York was dispatched to the small town of Sedan, Kansas, where he had grown up and worked at a community bank as a teenager. Everyone at the bank still knew him as Johnny, his childhood nickname. I was the officer that went in and told the board that you know you're going to fail. It was terrible, York said, particularly when they're calling you Johnny, which only my mother called me. Honig had to deliver many such verdicts personally. He didn't seem to flinch from the responsibility. Tom German, York said, referring to the ethnic origin of Honig's name, he's strict. There's rules. Honig was cursed at, shouted at, and informed in the clearest way possible that his decisions had ruinous consequences. They could become quite stressed and quite vocal in their objections. Honig said of the bankers, "You could empathize with them enormously. You could understand the anguish. Lives were destroyed in this environment. People lost everything in this environment. I didn't blame them for yelling or being distraught." It would have been easy enough for Honig to blame the bankers when the bubble burst. Examples of banking grotesquerie were abundant. This is what happens in a speculative bubble. Stupidity and risk taking thrive during the upswings, then cause misery on the downswing. But Honig didn't think the stupidity in lending was entirely the bankers' fault. They were, after all, responding to macroeconomic conditions like rising inflation, relatively low interest rates when compared to inflation, and rising asset prices. It wasn't the bankers who created these conditions. It was Honig's own institution, the Federal Reserve. The fact is, bankers made the loans, Honig said. They made, just a second, they made them in an environment of incredible, incredible optimism in terms of asset values. And that really was in part the fault of a decade too accommodative monetary policy. This was the dynamic that so often gets lost in discussion about inflation of the 1970s and the collapse and recession of the 1980s. The Fed got credit for ending inflation and for bailing out the solvent banks that survived it. But new research published many decades later showed that the Fed was also responsible for the whole disaster. Perhaps the most detailed account of how the Federal Reserve handled the Great Inflation is related in The History of the Federal Reserve, a remarkable 2,100 page book split into 3 volumes that is dense to the point of being nearly unreadable. The author, the economist Alan Meltzer, reconstructed the Fed's decision making during the 1970s using transcripts from FOMC meetings, combined with other public documents and detailed economic studies and data. His verdict on the inflation of the 1970s was stark. It was monetary policy set by the Fed that primarily created the problem. The great inflation resulted from policy choices that placed much more weight on maintaining high or full employment than on preventing or reducing inflation, he wrote. For much of the period, this choice reflected both political pressures and popular opinion as expressed in many polls. This statement was combative and inflammatory as far as Fed economic history goes. What Meltzer was saying was that the Fed basically didn't know that it was doing during the 1970s. Maybe even more demeaning, he was arguing that the Fed was not the independent agency it claimed to be. The members of the FOMC were not wise technocrats making decisions about the money supply, guided by nothing more than high minded economic theory. They were humans, driven at least in part by political pressure, Meltzer said. The Fed kept struggling to boost economic job creation by printing more money, not because the economic equations dictated it, but because that's what the public and the politicians wanted the Fed to do. The FOMC believed the unemployment rate should have been close to 4%, but it never fell below 6% between 1975 and 1977, and was still nearly 6% in 1978. So the Fed kept printing money and in doing so, it stoked the asset and inflation bubbles that created ruinously high unemployment rates above 10% in the early 1980s. Part of this was due to honest mistakes. The Fed was making decisions based on data that was eventually proven to be wrong. This was only uncovered years later after the data was revised. One key piece of mistaken data was consistently low estimations of price inflation. This was the equivalent of artillery specialists firing off the howitzers while using data from faulty weather balloons. The outside conditions were different than the team inside the bunker believed them to be. But the problem was more fundamental than mistaken. There is strong evidence that the Fed during the 1970s didn't even truly understand how monetary policy was affecting the economy and stoking inflation. In a 2004 report, the Fed economist Edward Nelson wrote that the most likely cause of inflation during the 1970s was something he called monetary policy neglect. Basically, the Fed kept its foot on the money pedal through most of the decade because it didn't understand that more money was creating more inflation. This wasn't done out of malice, but out of misunderstanding. The Fed, along with many prominent economists of the era, believed that the country was experiencing something called cost push inflation. This theory holds that a bunch of external forces that had nothing to do with the Fed were pushing up costs. Big labor unions, for example, were pushing up the cost of labor, and Middle Eastern cartels were driving up the cost of oil. It was these costs that pushed inflation higher and higher, not the Fed. Decades later, a very different understanding of inflation took hold at the Fed. This was the demand pull theory, which located the blame for inflation squarely inside the Fed's boardroom. By increasing the money supply, the Fed stoked demand for debts and loans, which pulled inflation higher. Cheaper money meant more loans, more borrowing, and more demand for everything, which further pulled up prices. This idea is commonly described as the phenomenon of too many dollars chasing too few goods, meaning that when you print more money, people use that money to buy things and it drives up prices. The same force drives up consumer prices and asset prices alike. In the 1970s, the Fed left the job of fighting inflation to others. The White House imposed price and wage controls, trying to keep costs lower. This gave the Fed freedom to keep interest rates low and increase the money supply. Every time unemployment rose or economic growth slowed, the Fed cut rates and printed more money, and this pointed to the deepest problem of all, at least in Meltzer's account of the fiasco. The Fed was reacting to short term pressures, and in doing so, it was pumping out new money that created long term risks. The members of the FOMAC were reading the news like everyone else, and they didn't want to be accused of making things worse during a decade of race riots, recessions, and protests. Whenever the FOMAC tried to raise interest rates, which would have cooled inflation, the committee quickly retreated because unemployment rose and or growth weakened. Although many FOMIC members understood that reducing inflation required consistent long-term action, there is scant evidence of longer-term planning, Meltzer wrote. This lesson of the banking crisis stuck with Tom Honig. It would make him stubbornly passionate decades later when he debated quantitative easing. Honig had seen firsthand how an phomic decision made in a day in a single vote took months or even years to express itself fully in the world as the effects filtered out through the banking system and the economy. Monetary policy operates with what they refer to as long and variable lags, Honig said later. He said this repeatedly, sometimes in a way that looked like he wanted to pound the table or to get his point across. His frustration stemmed from the fact that this piece of hard earned knowledge seemed to be ignored at every turn. When there was a short term trouble, like a drop in the market or a jump in unemployment, the Fed intervened. It printed more money and cut interest rates. It addressed short term problems and left the long term problems to grow. During the 1980s, Honig and his colleagues in Kansas City were left to sort out the long term problems the Fed's short term thinking created during the 1970s. The biggest mess they cleaned up was the failure of Penn Square, a bank in Oklahoma that had extended a chain of risky loans during the 1970s. When Penn Square failed, it almost took down the entire U.S. banking system with it. It also illuminated a second important matter that would harden in the coming years. The Fed didn't just stoke asset bubbles, it found itself on the hook to bail out the very lenders who profited most off a bubble as it rose. Some banks, the Fed was about to discover, had grown too large and too interconnected to fail. Penn Square was run by a guy named Bill Beep Jennings. He was a sort of person who drank beer out of a cowboy boot to impress clients, so it wasn't surprising that he figured out creative ways to extend countless loans in an oil boom. Penn Square was an early pioneer of what called securitization, whereby the bankers create risky debt and then sell it to someone else. Penn Square's version of securitization was the scale of a participating loan. Jennings would loan money to an oil company, then sell most of the loan to another bank while keeping a small share of the debt on its own books. The idea was simple: extend as many loans as possible, collecting fees with each deal, and move the actual risk of the loan default onto someone else's balance sheet. This helped Penn Square avoid rules requiring it to keep a certain amount of cash reserves on hand. Penn Square also gamed rules that limited how much money it could loan to any one person by using complex webs of interlocking shell companies and partnerships. There was a loan limit of 35 million per person, for example, but Penn Square still managed to loan 115 million to an oil executive named Robert A. Hefner. Going through all the schemes would fill a book, and in 1985 it did, with Philip L. Zewig's Belly Up: The Collapse of the Penn Square Bank. But the result was simple. Between 1974 and 1981, Penn Square's assets jumped from 35 million to 525 million. Many of these new assets were energy loans written on the optimistic premise that oil prices would only keep rising. On the way up, Beep Jennings was hailed as a financial innovator and a charmingly brash risk taker. When Paul Volcker and the Fed raised the cost of borrowing, it killed demand for the loans Penn Square was selling and turned Beep Jennings into a literal beggar. Jennings and his team desperately petitioned the Kansas City Fed for discount window loans that would keep the bank afloat. Like so many others, they said they just needed more time. This effort grew more frantic in the summer of 1982. Penn Square was petitioning the Kansas City Fed along with the Federal Deposit Insurance Corporation, or FDIC, an agency created right after the Great Depression. The FDIC was the grim executioner that arrived when the Fed's discount window was no longer an option. The agency liquidated insolvent banks using taxpayer money to repay retail customers who had accounts at the bank with 100,000 or less in deposits. The FDIC and the KC Fed went back and forth about Penn Square. The Fed provided millions of dollars in emergency loans, but Honig and the Fed lawyer John York were growing skeptical that the bank could survive. Letting Penn Square fail would wipe out millions of dollars in equity, but letting the bank stay alive and continuing to borrow from the Fed and others could make things worse. That can't be a real mistake because that can lead to larger losses, York said. The FDIC paid for these deposit losses by drawing on a fund that it collected in fees from banks. When that fund doesn't have enough money to cover losses, then taxpayers can be on the hook to cover losses. Time ran out over the 4th of July weekend in 1982. Honig worked on the holiday, poring over numbers to help determine if it was too risky to make another loan to Penn Square. The Fed's Board of Governors was also involved at an emergency meeting in Washington that Sunday. Paul Volcker had cast his own vote on the matter. Penn Square should be allowed to fail. On Monday, the verdict was rendered final through a series of letters between the FDIC, the Fed, and the Treasury Department's Office of the Comptroller of the Currency. The FDIC pronounced Penn Square insolvent. The Kansas City Fed declared Penn Square was ineligible for more emergency loans. Tom Honig had the duty of breaking the news to Penn Square. The bankers' response fit the pattern that Honig had grown accustomed to. They would say, "It's your fault we're failing. If you gave us more time, we could work this out," he recalled. But the really important thing about the failure of Penn Square is that the damage was not contained. The failure was just the first shock in a large cascade of shocks. There were still all those participating loans they needed to contend with. It was only when the loans started failing that it became clear just how broadly they had been infected in the banking system. The loan failures revealed that a very large bank in Chicago called Continental Illinois National Bank and Trust Company was one of the biggest customers for Penn Square's assembly line of risky debts. Continental Illinois had purchased $1 billion worth of these loans in just a few short years and toward the end of the 1970s. This caught everyone by surprise. Continental was seen as a conservative, even boring bank. It lent money to auto companies and steel makers in the Midwest. But the forces unleashed during the Great Inflation were too much for it. Continental Illinois pushed out along the yield curve straight to Oklahoma. Continental had become the biggest commercial and industrial lender in the country. In 1984, it had 40 billion in assets. Things fell apart quickly when the oil loans went bad. Continental was the problem of the Chicago Federal Reserve, which extended a 3.6 billion emergency loan to the bank. Even this wasn't enough. New York's J.P. Morgan pulled together a group of lenders to assemble a 4.5 billion line of credit for Continental, but that also wasn't enough. Continental's customers lost faith in the bank and started a bank run, withdrawing about 10.8 billion in a year. Continental was going to fail. Even Paul Volcker became nervous when he was faced with the failure of Continental Illinois. He communicated constantly with the FDIC as the bank teetered. He warned that Continental's collapse could not be contained. The bank was simply too large and too deeply connected with too many other banks. The FDIC estimated that 2,300 banks had money invested in Continental. About 179 banks had so much money in Continental that it amounted to more than half of their equity. Its failure might drag them down with it. Even more worrisome, about half of those banks were insured by the FDIC in case of failure. This would put unprecedented strain on the FDIC, which was already handling about 80 bank failures. The FDIC and the Fed came up with an alternative. The FDIC provided an extraordinary rescue package, injecting 1.5 billion into Continental. But most importantly, the FDIC promised to cover bank losses above a previously set threshold of 100,000, protecting all bondholders and depositors. This was a huge increase in the safety net for banks that invested in Continental, while knowing that the FDIC would only insure part of it. Now all of it was insured by taxpayers. Simultaneously, the Fed promised that it would give Continental emergency loans until the crisis passed. The Continental bailout was one of the most important legacies of the Great Inflation. If a bank got big enough and spread enough risk to other banks, then that bank could be rescued in a crisis. The previously existing rules would be bent or rewritten to save the bank. This president brought a new term into the vocabulary of American banking. During a congressional hearing about the Continental bank bailout, a Republican congressman from Connecticut named Stuart McKinley described the situation in a pithy statement. Mr. Chairman, let us not bandy words. We have a new kind of bank if it's too big to fail. Paul Volcker's career as a chairman did not end pleasantly. He had wiped inflation and was then driven back to the wilderness. FOMIC members cast dissenting votes against Volcker more often than at almost any chairman in modern Fed history. He asked not to be reappointed after his term ended in 1987. Volcker's halo would only be bestowed in later years, when economic historians decided that his efforts against inflation had been independent-minded and uniquely effective, but he was never again at the center of American power. Things worked out better for Thomas Hoenig. The wave of bank closures eventually receded in the Kansas City's Fed district. The Penn Square failure was the worst of it. Honig's performance during the crisis was noted by the people around him. Like York, who believed Honig had handled himself during a brutal period with integrity and competence. This reputation proved important when the Kansas City Fed President Roger Guthrie announced he was retiring in 1991. The Kansas City Fed had never hired a president from its own ranks, but Honig put his name forward anyways. There were about 150 applicants for the job. Guffey would choose his replacement with the help of the Kansas City Fed's Board of Directors. The Fed's chairman and the Board of Governors in Washington would also need to approve the hire. Guffey had seen up close how Honig handled the Penn Square crisis and thought he was right for the job. Honig won approval from the Kansas City's Fed's board and then flew to Washington to sit for interviews with each Fed governor. Finally, Honig was ushered in to the office of the new Fed chairman, Alan Greenspan, whose soft-spoken economist with many decades of political experience in Washington. Greenspan had worked on Wall Street and in the White House under President Nixon and Ford. Greenspan became chairman shortly before the stock market crash of 1978, and he won nearly universal praise for his deft handling of the crisis. He developed a reputation for maneuvering the Fed's levers of power gracefully like a surgeon. Greenspan was inscrutable behind his large, owlish eyes. During the job interview with Tom Honig, Greenspan listened more than he talked. Greenspan asked Honig about his theories on monetary policy. Honig said that the crisis of the 1980s had allowed him to see the powerful consequences of the FOMC's decisions. Honig had overseen the banks when prices and asset values were climbing, and he had seen the long and variable lags that occurred when the FOMC kept money too cheap for too long. It had fallen to him to dispatch the failed banks after Volcker brought inflation to a violent end. I was someone who was aware of the effects of easy policy for too long, Honig recalled. I through policy should be done very carefully with an eye toward inflation. More than that, Honig believed that monetary policy needed to be made with restraint and a long-term view. Every action you take has long-run consequences, he said. Greenspan was silent on this matter as Honig remembered it, but the chairman apparently approved. Honig got the job. After the news went out that Honig was president, one of his elderly neighbors approached him with a gift. It was a framed copy of a piece of German currency, a single bill with the face value of 500,000 marks. Below the bill was a simple inscription that read, "In 1921, this note would buy a large home. In 1923, this same note would buy a loaf of bread." It was a living memento of Germany's era of hyperinflation. Honig hung it in his office downtown. It was a good reminder of the destructive power of inflation, or at least the first kind of inflation, meaning price inflation, which can make a currency almost worthless. But Honig was worried about the other kind of inflation that he'd seen in asset prices. He could have just as easily hung mementos on the wall, such as the bank charters for Penn Square and Continental Illinois, to remind him what happens when rising Asset prices exert their own logic on borrowers and lenders. And what happens when fragile bubbles bring the entire financial system to a halt? Within a year, Honig was sitting at the giant wood table in the Eccles boardroom, at the same table as Alan Greenspan, as a member of the FOMIC. He never forgot what his neighbor told him when he imparted the gift. If you want to have it, I want you to have it to remind you of what can happen if you do your job poorly. All, all right, everyone. Thanks for tuning in. We're going to leave off there and pick up on chapter 4 in the next video. Please remember to hit the like button and subscribe if you haven't, so that way we can grow the channel and get this out to more people. And on the channel, The Millennial Messiah, we believe that education is important. Education is part of growing, and intelligence is of God, and it is godly. So we do our best here to gain as much education as possible, whether it be spiritually, temporally, or a mixture of both. So please hit the like button and subscribe, and I will look forward to hearing from you in the comment sections. If you have any comments or just want to complain about how we're dealing with inflation currently in the U.S. pretty badly because of the Fed. The Fed is really ultimately who is at fault, and they're not even an elected governing agency. But with that said, let us look forward to the Savior, Jesus Christ, our Savior, Redeemer, in whom we can gain strength to overcome all things. And I'll leave this with you in the name of Jesus Christ. Amen. And I'll see you guys in the next video. Have a good day. Bye.